All right, guys, welcome back. Welcome back. So that intro should have gave you a little clue about what I'm getting at here. This is going to be, I guess, analysis of the SPY, ES, MES. I'm on the micro chart because that's what I traded today. Um, I said I thought today was going to be a down to side day, and we ended up with a doji. It's kind of exactly what we It was a trading range day. I just knew, well, I just felt that there wasn't going to be a trend today after all this, and it was because of this that I'll share with you here. So, you guys got an idea of how this all comes together here. This is going to be analyzing the pushes that the market is able to give you without anything else, just the sheer result of all the effort. Okay, we're not analyzing volume in this, we're not trying to do any of that. We're just trying to look at what was the conviction level and how far did they take it, how far did they push it. So we're up here on the daily chart, and you can see that there are 6 of these and there's 6 of these, and they all correspond to each other. So it started with this move here, and they responded with this move here. Okay, and then we got a big response from the bears here, and this is all we could give them back as an answer. Okay, then they came back and pushed a little more, so they erased this again. Okay, and then more bulls got interested in buying. And then the bulls or the bears tried to fight back again. And they were going back and forth here. Okay, with that. So we do it like this. And then the bears really took it down on the next try. And how did the bulls respond? We've gotten a rally that's almost, not all the way, almost has recovered that. Okay, and that's where we were today. So in order for this, to be balanced, and I don't mean balanced like they're all the same movement, like, you know, I don't mean balance like these are all the same size boxes. As you can see, that's not the case here. This one's bigger, smaller. This was a response, initiate a response, initiate response, and then this big one here is probably a little climactic. It was 3 times as big as this one here, the 118. Yeah, 3 times as big as that, almost. And then they came back and pushed it up here. But look what's happening up here now as we see this play out. So we're either looking for, before the trend turns around again, we're either looking for, let's copy this, let's clone this here. Looking for one of these. Again, what's the likelihood of that happening before there's a response from this team after this big response? You should at least get one of these. You should at least get one of these. The question is, though, will they come back and be even stronger than they were before, and then they give another response? Because if they do, we're still going to be lower than we are right now. All right, so if we just take these right here, these are the last 2 responses before that. I'm going to show you another cool thing you can do with these 2 with the averages. But we put this here. Okay, let's say they're able to duplicate what they did here, the bears. All right, they would go below this low. Okay, and if the bulls were able to duplicate what they did here, they wouldn't get back to this high, so it would still be a lower low. So we're still in a downtrend. We've just reclaimed the 200. We've just reclaimed the 20. And this is a daily chart, so they're very significant. And we've got this level up here on the SPY that's potentially a double top if this doesn't follow through. If this doji follows through to the downside, so it's a doji right now, I'm expecting this to continue down. My trend line traders, we got your trend line here, got your channel line here. Okay. The only bearish or bullish thing that I see on this right now is that these right here typically break to the upside. The downward sloping channels, they break to the upside a high percentage of the time, over 70% of the time. So that's the only thing that I see here, but it doesn't have to break right now. We thought this was a break. We thought this was a break. It doesn't have to break right now. It can just go up and then come right back down and then get ready to break. So, but this is what I want to share with you. Trading is probabilistic, right? It's what is probably going to happen next. And it's probably going to be what has been happening, okay? And what has been happening is we've been in a trading range. You can see this is a trading range. All of these little numbers here, all this back and forth, this is a trading range. It's a downward sloping trading range. And you can see it's a range where the bears obviously had the advantage. Okay? So what we can do on this though is we can work out an average move. You simply add all these together and you work out the average move of the last 5 or 6 moves, however many we want to track. Let's do that for each side. Let's separate them and then figure out what the average move is. Hold on. All right, so we're going to do the red first. We're going to do all of these as an average move. So we've got 118 plus 294.50 plus 134.75 plus 96.75 plus 302.25. And how many are there? There's 1, 2, 3, 4, 5. So it's the last 5 moves. We're going to divide that by 5. What do we get? An average move of 189.25. Might not let me nail it there. We'll get close. Okay, that's close enough. Okay, and then we're going to do the same thing for this right here. Get 87.75 plus 94.50 plus 192.25 plus 91 plus 270.75. And there's also 5 of those. You're going to divide that by 5. So this average move is 147 and 147.25. So we come over here to this one, 147. Okay, that's as close as I'm going to get. So now you have average moves mapped out on this. Okay, so anytime they move more than an average move, they're moving above average, there's more interest in the other side. So what I like to do when I'm trading long-term charts, like I have options or something, I like to place the average move where my entry is, and I like to use that as my stop. Because over the last 5 moves, this is what they've moved on average. So if they're going to move more than this, okay, what is it going to protect me from? It's going to protect me from this, and it's going to protect me from this, okay? And when I say protect me from, I don't mean that it's going to stop me from getting stopped out. It's going to make sure that I get stopped out when it's probably, the probability is probably shifted in my favor to go the other way, okay? Does that make sense? So, for instance, if I were to sell here, okay, I would put the opposing moves stop loss right here and put my stop loss up at the top of this, because this is the average move of all of this. All right, and the only 2 that really threaten me are this one that rallied, this whole rally we just saw here at 270 points, okay, or this one here, this 192, okay. Can't see it, it's kind of, this 192 would also stop me out. And that's really what you want, because all of these other ones, all these other moves that it's made recently, they fit inside of here. You see that? All those other moves fit inside of your average move. Only these 2 outliers, okay, are the ones. So you're really protected from, if there's 5 of these, you're really protected from 60% of them by using the average stop. And it's reasonable. Think of the logic behind it. If you're going to move more than the average, which these did not, and these 2 did, you don't want to be in a move past that anyway. Okay? So what I do is I would put my stop here. I put my average stop here because I've calculated the swings that they're usually able to make. For my profit target, I would take this, and I wouldn't use the whole box. I would typically use 80 or 90% of the box. But even if you put the whole box here, right here, you're not even getting to the bottom of this channel, right? You're not even counting on them eking out that last bit of selling here into oversold, right? You just want them to fill this box, the average move. So for this average move here, they moved more than it once, twice, 2 times. They moved more than this, okay? But there's nothing stopping you from going, getting the average move, and then putting your stop here. And then if it goes down even more, you'll take more profits. If it comes up and stops you out, no big deal. I did that today, intraday, with some contracts. It hit my target based on these, and I moved my stop to that target, and it went a little bit lower. It looked like it was gonna, keep falling, and then it came back up and stopped me out. So I was fine with that because I hit my target. But it's just one of the ways you can use it, because you're literally adapting to the market, the recent market action as it's happening, and you'd be surprised how many times intraday you can draw these boxes, and they will line up the moves, the moves of what are coming next. Okay, let me show you an example here. Let's get rid of the daily boxes. Get rid of the daily boxes. Let's start here at 8 o'clock. I use this tool here. I don't even know what it's called. What is it called? The price range tool. I use the price range tool. Okay, and I just go from high to low. And that was an up move. And then I'll drag it here. And I'll do this at the beginning of the day, just to give myself something to do while the market tries to pick a direction, right? I don't want to be in every single market all the time. And then when it hits a bottom, I'll take that. That was a down move. Down move there. And I'll put that there. Or maybe I'll put it next to it, just to compare it. So already from these two moves, from here, the open up, to 15 minutes later, the bears are stronger. You see how you can tell that right here? The bears are stronger. Okay, not by a lot, about 3 points. They were able to push it down. So what's the next move look like? I'm going to push this up here. They were able to push it from here to here. That's an up move. Okay, this is how the bulls responded to that. We'll line them up so you can see here. This is the highest they could go. And then the bears came back again. Okay. And they were able to beat them again. So this is telling you that we're going to definitely not balanced. We're a little more balanced than trending, but we're not balanced, and the bears have control. But then after they come down here, what happens? The bulls come back up, and before they can really push it down again, that's what they get out of it. Okay, so that's a pretty good response to that. All right, and the bearish response was this here. Okay, a little bit weaker. This is a little bit weaker than their last response. Okay, but it's still pretty good. So now we see what the bulls have. Can they put in something else like this? This is what I'd be wondering. Can they put something else in like this? Right here. Because if they can, this is where you would expect them to go. Okay? But you see that they can't. Alright, so let's look at this. Let's take the first 3 bullish moves right here. Okay, take the first 3 bullish moves and get an average of them for this trade. We want this bullish move to, because right now we saw bullish, stronger bears, bullish, weaker bulls, stronger bears, strong bulls. I wouldn't really call these weak, but they're definitely weaker than this, but they're stronger than this. Okay, so when your lowest strength is better than this lowest strength, You got to kind of give it to this team here. Oh, let me do that. So we've got 850 plus 850 plus 8. And that's 3 movements divided by 3. So it's about 8.3. So we'll go 8.5. The average move up right now, based on the last few movements, is 8.5. Okay? So you want to measure from here to here and see, can they give you 8.5? And they can't. This is the low of that move. Okay? This is this right here. Okay? This is the low of that move. And they can't give you 850. They can't give you the average. What they do give you, though, is 650. So 2 points off. Okay? They give you the 650. And then how do the Bulls or the Bears respond? Okay. Let's add up the bearish pushes and see what their average is. You had 1150 plus 850 plus 8. You divide that by 3. So they're about a 9.3. And they're about a 9. Let's do 9.5 or 9.25. Okay, so this is their average move right here. So after this, how do they respond? If you put the average move on this, the average move on this went down pretty much from here to here without being interrupted. Okay? And you don't get that. You don't get 925. Okay, you get 750. So you compare that to that. Now you got less than your average, for sure. But you got more of your total range than they did. They missed theirs by 2. You missed yours by 1 if you're bearish. So then we look at what the Bulls can give you next. What was their average again? It was 850. I'm not getting 850 out of this. Not getting 850 out of this. You're getting 6 again. Once again lower. So if you're looking at this and you haven't taken a trade yet because it's now 10 o'clock or 11 o'clock, okay, what's the next thing for the Bulls to do or for the Bears to do? This is their average. Look how much more they give you than their average this time. 925 is their average. They give you more than their average this time. Okay. How do you expect them to respond? This is their average move. Probably should update the averages by now, but you get what I'm saying here. And this is how they respond to that. Okay. So this is kind of simplified version because it doesn't matter the reason they bought or why they, all of the activity that went into it. What was the result? What can I trade off of? Like, I can't trade off of an idea or you're selling because of a reason. I can trade off of what price is doing. And price is what's going to pay me. So that's what I need to be paying attention to. Okay. So after this move down, it's pretty big, right? Take that move and put it here. And this is the one that I played right here. This is the one that I played that I was talking about earlier in the video, where it hit my target. I shorted up here. I put my average stop here for them, and I had calculated all of these, so I had probably a lower average than the first 3 alone because they've just been declining ever since. And I put my average move for this down here because I wanted to measure move down, and I got that. And this is where it stopped here. Looked like it was going to continue down. I put my stop here, and then it came back up and stopped me out. So this is just, if you're a very visual learner, very visual trader, I'm very visual. That's why I like trend lines. And this is just something else that I do regularly enough that I thought I'd share. All right, if you liked the video, you know what to do. See you in the next one. Peace.